And when the recession hits, which will be a 2023 event, the market will find the bottom somewhere between 35 and 40% below its peak of 4,800.
2022 was a wild year for the economy and a tough year for the average investor. The S&P 500 is down, cryptocurrencies have gone down the tank, and the property market has been dwindling. But there's good news. Wealthy people, and more specifically people with wealthy mindsets, are using this recession as an opportunity to make money and truly become rich. In this video, I'm going to break down this 2023 recession and go over the best ways to invest, so let's dive in. So despite the fact that property, cryptocurrency, and stocks are very different asset classes, they have all gone down, and because of two very important factors that I'm sure you've been seeing on TV, in social media, in the news, and so on. I'm talking about interest rates and inflation. During the lockdown periods, the Federal Reserve printed roughly $4 trillion as relief for businesses. And this did help people out in the short term, but unfortunately you can't have the good without the bad, and the bad in this case was that inflation soared to 40-year highs. To tackle this problem, the Federal Reserve has had to raise interest rates. When you have high interest rates, people are less likely to borrow money, and so because they don't have as much money, they don't have the cash to buy goods and services. So the demand for these goods and services go down, which is meant to help stop prices inflating as supply and demand are back in line with each other. But by the end of 2022, we had very high inflation at about a 7% rate. Interest rates also climbed up to about 4%. So that's where we're at currently, and this is very important information to bear in mind as we move forward to understand how you should be investing. So there are four main things that you need to consider when investing during a recession. 1. Are you actually able to invest? You need to figure out if you're in a financial position to invest in 2023. If you don't have savings, if you don't have spare money to invest, then you just need to wait until you do. And the reason for this is very simple. Investing is a long-term game. In the short term, your investment portfolio will spike up and down, so you need to be in the market for a few years before truly seeing a return on your investments. So you need to take a step back and look at your finances and see how much you're okay to part with for a few years. The best way to think about it is, am I okay with not seeing this money again? Of course, you will most likely get your investment back and then some in years to come if you invest correctly, but it's important to have the mentality of, I'm putting this money aside and forgetting about it, so that you can make a more risk-free decision. By asking yourself this question, you can figure out if you're in the financial position to make investments. This way, you'll invest money that you can afford to spend on investing instead of putting in money that you need for rent, for food, for essentials, and so on. If after calculating everything, you find that you don't have enough money to make investments, don't sweat it. It's far better for you to wait and save up a set amount of money that you want to invest. And another thing to bear in mind as well is having an emergency fund. You need an emergency fund right now, far more than you need a pot of money to make investments. Recessions are great as an entry point for beginner investors, but they aren't great for workers. And the reason for that is, as I've mentioned, because of these high inflation and interest rates. As companies earn less money and start cutting costs, they start laying a lot of people off, which is what we've been seeing. So you also have to ask yourself, will I have stable income over the next year or two, and do I have an emergency fund? So it's only once you're past this stage of knowing if you're in the financial position to make investments that you can begin investing. 2. Consider interest rates. So it's looking like we're going to be dealing with high interest rates this year in 2023, and it's definitely going to be much higher than we've seen in the past few years. Now, what does this mean for investors? Well, high interest rates make life difficult for businesses, and that's because servicing debt costs more, opening new stores requires more money, and on top of that, people have less disposable income to spend on goods and services that makes up the company's revenue. So in a nutshell, for companies, high interest rates mean that costs go up and revenue goes down, which mean less money overall. In the real estate market, we see something similar, as high interest rates mean higher mortgage repayments if you have variable rate debts. So if you've invested in real estate, your returns will drop because the rental income is being used to pay interest instead of going into your pocket. As rates rise more homeowners will be motivated to put their homes in the market, which means that the supply of houses on the markets will increase, which puts pressure on prices. But the one asset class that does seem more enticing in light of rising interest rates is government bonds. As rates increase, the coupons on new government bonds also rise. But remember, if rates keep rising after you buy a bond, then the value of your bond will go down as the newly issued bonds with even higher coupons come out. 3. get to know the business. You need to focus on each individual investment rather than just looking at and following general trends. Of course, it's important to know background information and other contextual knowledge like inflation and interest rates as I discussed, but that's not enough to make a well-informed investment decision. These factors can bounce around, they might not always apply, and you might not always be up to date with them. You should always go back to analyzing each individual investment and company purely based on its fundamentals, like Warren Buffett does and encourages. Most people get carried away and try to predict the stock market, which is a waste of time and energy because it's unpredictable. That's just the nature of the stock market. You can't predict interest rates. It's super helpful to know this type of information, and you should definitely try to keep on top of it as much as you can, but investing properly ultimately comes down to understanding the fundamentals of a company or asset before making the decision to invest. So now you're probably wondering what those fundamentals actually are. Well, you need to ask, is there a competitive advantage backed up by the numbers, aka uninterrupted growth in revenue, earnings per share, free cash flow, equity? Is the management doing a good job? Do they keep debt low? Is the return on investor capital high? And then finally, what's the valuation on this business, and are you able to purchase the shares at a discount to intrinsic value? Use these questions to figure out whether a company is actually worth investing into. A lot of this stuff is common sense. Get a feel for whether you think a company is set up right to succeed before making an investment decision. A great company will bounce back even in tough times where there are high interest rates and the economy is in trouble. So zoom into a company and make this the biggest weighing factor of your investment decision over other trends that might be going on. 4. Get a hold of your emotions. This one is going to be very important in 2023 with emotions running high as the economy is down. In a nutshell, the stock market is all about buying low and selling high in layman terms, right? But most people actually do the opposite. They buy high and they sell low, which sounds silly. Why do people do this? Well, when the stock market dips suddenly and it's in all the headlines, people panic and sell at a loss out of fear, which happens all the time and which is how market crashes happen. There's one huge group of people who sell out of fear, which scares another group of people to sell, and so on until the stock market crashes. But to truly become a successful investor, you need to get a hold of your emotions and not act out of fear. And the reason why that's so important right now is because it's easy to feel negatively affected by the news, by the people around you having a difficult time financially, and so on. But investing is a long-term game, and if you're not going to be in it for the long term, you may as well not be in the investing world at all. Take the opportunities that you have in 2023 to buy low if you're in the financial position to do so. Make your investment choices wisely, taking into account the economy, but more importantly, the companies themselves, and be prepared to hold on to these investments for years before seeing returns that can truly make you rich. The markets will most likely be very volatile over the next year or longer, so you need to absolutely have your emotions in check and think logically. But if you follow all of the tips that I suggested in this video, then you'll be in a far better position for your investing journey in 2023 without having to panic and worry. If you enjoyed this video, be sure to like, comment, and subscribe for more awesome videos about investing, and I'll see you next time.